Hey guys, Toby Mathis here, and today we're going to go over a review of the infinite banking system, and we're going to talk about these types of policies in a little bit of detail. First off, I'm a tax lawyer. I've been doing this for a long time, and I'll just go right to the code. It's 7702, and what that says is that cash value of certain types of financial instruments, like life insurance, can grow tax-free, where you're never paying tax on it. Just keeps going on deferred, and so long as you just let that cash value grow, eventually you're able to access that money via things like loans that are also tax-free, and you just let that thing keep growing until you pass away, and then insurance proceeds are tax-free. So you end up with this great big policy, huge death benefit that ends up paying out to your heirs absolutely tax-free if you set it up appropriately. So people call this the infinite banking system because they'll set up a policy. Usually it looks something like this. So they'll set up a policy, and that policy has two sides to it. The two sides are, we'll just say, we have the death benefit, and we have the cash value. I'm just going to call it CV for ease of writing. The cash value is what you access during your lifetime, right? And that cash value is going to compound tax-free. So if you do nothing but set up a policy and continuously fund it, this is a life insurance policy, so I'm just going to call it a life policy. It covers me from day one as far as the death benefit's concerned. I'm going to be paying extra amounts into it that cover up the cash value. So when you're making a payment, part of it's going to go to the cash value and part of it's being used to pay that death benefit. But once it's in that CV, once it's in that cash value, now it can grow tax-free. Now, there's two big, kind of camps when we're talking about the type of policy. Now, when you're talking infinite banking, you're almost always talking about whole life. Permanent insurance that's paying you a dividend. In other words, you own a mutual insurance. It was, the gentleman's name is, I think it was Nelson Nash, who authored a book called Becoming Your Own Banker, right? And he starts talking about you're putting money into this mutual insurance, this whole life policy, and as that policy grows, it's being paid out. The profits are being paid out of the mutual company because you're actually an owner in it, and those dividends are going straight back into that policy, into that cash value, and it's growing. So over the longer you do these things, they start to compound and they start doing that little hockey stick that you see sometimes with the growth. So boom, you're putting in X dollars here, and then you're going to end up with 10X, 20X up here as it grows. And the idea is that you're borrowing, I'm just borrowing that money during your lifetime. And you know what your tax bill on borrowed money is, right? It's zero. And then at the end, when you pass away, that death benefit pays back the cash value, and you pay zero again. And then the remains of that death benefit, which are statistically, they have to be higher than that cash value. Otherwise, you have what's called a modified endowment contract. So we won't get into that. But that death benefit always gets pushed up. So that cash value, as it grows, so does that death benefit. And so you're actually in a situation where your estate benefits and you have access to this money. So this is the payout down here. So as you are going through life, if you have one of these policies, and if you've ever had the numbers run for you on one of these policies, you see that they project out on reasonable growth rates. Let's say it's a mutual, you can kind of predict by looking at the past. But if there's something like an indexed universal life, where instead of being a whole life policy, it's based, the cash value grows based on an index. It could be variable, it could be indexed, it could be, it's basically tied to the stock market in some fashion. You could see growth rates, usually when they illustrate them, I think they're at 7% by law, but those growth rates, like on the S&P, has been closer to 10%. You end up with these large cash values that you can use to borrow. What would I use the money on? Like, I'm borrowing from myself? Yes. In many cases, you're borrowing from the insurance company, and your investment can actually be making more money than what the insurance is costing you. So not only is it not a wash, you're actually making money. For a lot of years, that's exactly what was going on. Or you get a policy, in a case of a whole life policy, it's more likely than not that you're going to have something that's pretty much a wash, or you're going to have a wash where you're not literally paying back insurance, but that money is no longer growing in there because you've borrowed it back out, so to speak. So the interest is basically a wash. The growth is the same that you'd be paying it. But you borrow that money, tax-free, and now we can invest it in things like, let's say, real estate. Let's say that you're using it to pay for one of your kids' education. Maybe it's you have health issues, or you need the cash because you lost a job or something. Now you're going and you're borrowing directly from your own policy. You can't say no. It's your money. It's your cash value. It's literally secured by the money that's sitting in that policy, so they know they're going to get paid back. So you can take that money. I've actually have several of these policies. In one case, I wanted to see how quickly I could get the money, and it took me 2 days to get the check. That was it. It was very, very quick. In a lot of these insurance companies, they're designed for you to access that cash value early. In fact, they'll even table it out to show you how you can bolster your retirement, and you're taking X number of dollars every year. Here's how big the policy is going to be when you pass away, at the given ages and things like that. So you can actually use the math to predict what's going to happen in the future. Now, there are lots of folks that use these policies to fund their other investment ventures. So for example, if I know that I can borrow money from here, and I'm going to be paying, let's just say 4%, and I know that I can invest that into real estate that's paying me 8%, I can pay back that note at that 4%, and I can write that off, by the way, if it's for an investment property. But the beautiful part is I'm making more than that interest is costing me. No different than if I went to a bank and I did the exact same thing. It's just in this particular case, you are the bank. It's your insurance policy. So there's a lot of benefits. So things like retirement, real estate, health, education. I want to pay for my kids or my grandkids' education. You can even set these up on your kids so that they start building up cash value, so that when they go to college, they actually have access to capital. And all they're secured, like they're secured with their own life. They're secured by the death benefit, or excuse me, by the cash value, but that death benefit pays it back. So here's the important concepts to know. When you are doing these types of policies, you need to keep them in force. And there is a cost to maintaining them. So make sure you're clear on the cost of maintaining the death benefit so that the policy does not lapse. What I have seen people do is they'll put hundreds of $1,000s into the policy, and they'll borrow back out almost all of it. I've seen 90%, and the policy starts to lapse. In other words, you have to pay in to keep that death benefit going. Otherwise, the policy will cancel, and now you have a mess on your hands, because all that stuff that wasn't taxable now is taxable, and you can have an adverse tax consequence. So you want to make sure that when you're doing these, that you know your numbers and you know that you're going to be able to continue funding it. I want to talk about a few of the uses of these, and then I'll talk about the downsides. So we hit the lapse thing, but I'll go over, what the good, the bad, and the ugly is on these. So let's talk a little bit about the good. The good is this is a great vehicle to fund something like an estate plan, because you do have death benefit. Now, I'm going to tell you, when you are setting up this policy, the insurance agent that sells it to you, more likely than not, is being paid on that death benefit. So they may be saying, hey, let's get a big death benefit. You want the lowest death benefit and the highest cash value. The more you fund that policy, it's going to push the death benefit up anyway. So my personal view is that you try to get the biggest bang for your buck by getting the least amount of death benefit possible for the most, with the most cash value. So if you're going to fund this thing, let's say you're going to put $500 a month into a policy, and you're going to do it and you commit to like 5 years, you want to make sure you're getting that benefit. You're not just paying for death benefit. But if you are paying for death benefit, that is a wonderful vehicle for something like an estate plan. So if you're trying to create a legacy for your family and you haven't made all the money yet, you don't have all the assets, this is a safeguard so that if something happens to you, if you've used and you created something like a living trust that has a legacy component on it, hey, I want to pay for the education of my kids and my grandkids and my great-grandkids. I'm thinking ahead. I want to create a legacy. I want them to be able to travel the world, or I want them to be able to do things. Well, this funds it. Something happens to you and you haven't made your fortune yet, all of a sudden you have death benefit that dumps right into that estate plan. So that's number one. Number two is we like to use them for buy-sell agreements. In other words, if there's two partners in a business, what happens if one of them passes away? Well, do you want to be partners with the spouse? In some cases you can't, like if it's licensed activity. A lot of times you just want to have a buyout. Well, these types of policies are perfect for buy-sell agreements where I agree to buy you out, or you agree to sell it to me, and vice versa. We're partners in a business. Now, instead of having to come up with a bunch of cash to buy out your deceased partner's estate, there's an insurance policy that pays out to them. Here, this is for that. This is, you are selling me your interest. It's triggered on your passing, and the insurance funds the transaction. So there's buy-sell. We also sometimes see this when companies buy a policy so they can redeem the shares of their shareholders. So for example, there's 3 or 4 of us that were in a business, we're growing it, maybe it's a pizza shop, maybe it's whatever, maybe it's an accounting firm, right? It doesn't really matter. Who's gonna pay for that interest of that individual? So if we don't wanna do a buy-sell, maybe we say, well, the company is gonna redeem your shares at its fair market value when you pass. And what we're gonna do is we're gonna buy an insurance policy on your life so that the company gets the money so it can go ahead and redeem your interest. These are a little more complicated. It's called corporate-owned life insurance, but it's also a nice vehicle. And then the only question there is who has access to that cash value. In that particular case, it might be the company, right? So we're doing the same transaction, but we're doing it in a for-profit entity. Sometimes you're doing it in a not-for-profit entity. When we're doing a redemption, it's always for-profit because nonprofits don't have shares and shareholders. But in this particular scenario, let's say we did this with our business. There's 4 of us, and now nobody's having to buy out the interest. The company redeems the interest of its partner and pays that partner's family the fair market value, and it didn't have to come out of everybody's pocket. It was funded by the very passing of that individual. And so that's a buyback provision. The last one is a key man policy. Again, it's a company buying a policy on somebody that, boy, that company is going to get hurt if that individual passes away. And so maybe we want to have money dump in so that we can weather that storm of that individual going. Still, these are perfect policies for all of those scenarios. And again, it allows you this concept of using the cash value as your own bank. As that grows and I need access to it, I can absolutely get to it. Now I'm going to give you one last benefit that oftentimes gets overlooked, and I would say it's really critical nowadays, is these policies can get a rider on them for things that occur to you. If something happens to you and during your lifetime, you're older in life, and you want to make sure that you're continuing to have monies to live off of, and I'm not talking just about retirement, I'm talking about like things like assisted living or a memory unit, you could access the death benefit ahead of time while you're alive. We saw this a lot with terminal illness and things like that. There are riders you can get if you have activities of daily living that you need assistance with, which could be bathing, clothing. I need someone to come help me, and those things are expensive. Now, instead of me having to take a loan out or from a third party or having to dive into my retirement funds, I can actually borrow against that death benefit. Same scenario, I'm accessing the death benefit early for those types of things. That is an actual rider that you put onto it. Otherwise, you're just using your cash value and again, just borrowing it out to cover those expenses. But you can literally get a rider because the death benefit's always going to be more than that cash value. I might want to have a rider that allows me to get to that death benefit a little bit early in the case that I need it so that it's not detrimental to my family. Now let's talk about the downsides to these policies. I already mentioned the one. If you don't pay for it, it could lapse. The other thing you want to look at is sometimes the commissions can be high on these, right? Somebody might be saying, hey, I want to put in $50,000 a year. And if they're doing, there's actually financing for policies. So if they're doing a finance policy for the premium finance is what they call it. If they're doing that, it might be $100,000, $200,000, $300,000 a year that somebody's putting in and they're borrowing from a third party to actually put that money in there. Well, that agent may be making a killing off of that. Like I've seen policies that are paying the commission is hundreds of thousands of dollars. It's crazy. And what that is that's an expense that's going to be put on that policy. So when you cancel a policy, you'll realize there's something called a surrender value. You can usually tell how much that agent's getting paid. If that surrender value is really low for those first few years, it's because the insurance company paid out a massive commission to that. Be on the watch out. A lot of policies will spread the commission out over a period of years. A lot of agents recognize that they want their client to stay in that policy, so they're willing to spread their commission out over a period of years. And not all policies are the same. You need to shop them around. Like, you're looking at different companies to see what's the best deal for my scenario. Whole life may be really important to somebody who's older, whereas an indexed or a variable universal life product might be better for somebody who's younger. It's all going to depend on the numbers. It's all going to depend on your health, everything about you, the demographics that they look at when they're doing the actuarial underwriting. All those things play into it, and you can pick and choose, hey, what's the best thing for me? It's not a one size fits all. So there are costs associated with it. Number one is the commissions, but also running the policy. There are fees for somebody running that cash value. And you want to figure out what those numbers look like so that you're not in a scenario where it's like, hey, this is great, but all the money's really going to a third party for managing it, as opposed to staying in that cash value right there and for that puppy to keep growing. So sometimes there's high cost associated, and you want to make sure that you're looking at that. The third thing that oftentimes happens, depending on the policy, is your cash value may not be growing fast enough, especially in the early years. There are policies that are designed for things like real estate investors who need to get access to that cash. They're designed to allow a higher amount of the cash value to be loaned out because the expenses are being spread out over a long period of time, especially like that agent commission I talked about. And so you want to make sure that you get your head around those numbers. And most insurance guys, they'll give you the projections, and you got to look at those numbers. Or better yet, work with a fiduciary, somebody who has your interest in front of their own, because an insurance person, just a standard insurance person, does not owe you a fiduciary duty. A fiduciary duty is going to be owed to you by somebody by license or by the type of person. Like if they're a CFP, they owe you a fiduciary duty. Certain types of brokers, they owe you a fiduciary duty. A CFA, certain types of investments, like I'm an attorney, I owe you a fiduciary duty. CPA owes you a fiduciary duty. When we're looking at things, we have to do things that are in your best interest, as opposed to you go to the insurance agent, and a lot of times they may have a little bit of a conflict, right? They got this big commission, and but they want to sell you this, and they want there to be enough for you to get to where you want to do the policy, but on the same token, they're thinking, what's the best commission for me? And sometimes they'll lead you particular companies, particular types of policies. You want to make sure that when somebody's looking at you, they're putting your interest first, not theirs, yours. There's something called suitability standard in securities, for example. A broker just has to sell you suitable things, whereas the CFP has to put your interest before their own. Let me give you an example of suitability. You walk into a car lot and you got it's a family of four. They could sell you two Corvettes, two persons for each car, right? It's suitable, but that's not in your best interest. The best interest would be, an SUV or a minivan or something that would take care of your family, right? And you only need one vehicle that way. So you want to be looking and working with somebody who has to put your interests before their own, especially if they're sizable plans. Otherwise, I'll just say this. I love infinite banking. I love the bank on yourself. I love these different concepts where they're using a tax code provision to the benefit of the individual. I think that's great. I have these policies. I have several for different people, like check off the box on each one of these things, right? Because I have them, because I have partners, and because we want to make sure that we're looking out ahead into the future and saying, hey, we never want to be in a situation where somebody passes away and it's at the detriment to other folks financially that we could avoid. Like, is there something we could do to make sure that this isn't going to be a dispute, this isn't going to be a fight? Those buy-sells, those redemption agreements, they need to be in place early so that you can make sure that they're covered and that you don't put your partners into a bad situation, or you don't put your company into a bad situation, but they work like great. I have them. I know how they work. I've utilized them. They work fantastic when you go in with your eyes open and you know the benefits and you know here's what it's going to cost and you have people that you could trust. These are great policies for that reason. For real estate investors, I would really recommend that you start doing this early because you'd be shocked at the little pile of cash you have and how much easier it is. Hey, I just want to borrow for myself. I don't have to deal with hard money folks. I don't have to deal with traditional financing. I can just literally borrow from myself. And then it makes sense because we all are living longer lives. And the reality of it is, as we get older, there's probably a 50 or 60% chance that we're going to need additional assistance than just covering our basic overhead. And boy, these policies make it so much easier to get access to that capital tax-free. And then the benefit, that death benefit comes out once we're all going to pass. When we know that death benefit's coming out tax-free, what a great feeling knowing that what you did for your family. So yes, these are great policies. I think that they work excellent when you know exactly what you're doing and you don't put yourself behind the 8 ball, don't bite off more than you can chew. And the way you know, here's how much I can chew, is you run your numbers and make sure you're working with somebody who's got your back, who's looking at it from your best interest. And then once you do that, you're going to feel fantastic. And over time, as you fund these things, boy, those benefits just continue to grow.